Hey all, welcome back to our YouTube channel. Topic that we will have a look at today is from FRM level 1 and it's from paper 4, that is valuation and risk models, and it's from chapter interest rates. We will try to understand relationship between spot curve, forward curve and par rate curve. So there was a query that was asked in the one of the forums. In your books, it's just a table that has been given showing the relationship between three curves, but that may not give you more insight. So this video will help you out to understand relationship in more detail. And before we go ahead, please do subscribe to our channel, like, share, and comment the videos. And yes, you will notice that some stimulation to your thought process that will definitely help your understanding on spot, forward, and par rates. So before we understand relationship between these three rates, like spot, forward, and par rate, let's understand what these three things mean. So first one is, say for example, if I'm talking about T period spot rate, it's usually denoted by ZT, and it's a yield to maturity of a zero coupon bond on the T years maturity. So if I were to tell you it's a YTM on zero coupon bond with T-year maturity, very important to note, it assumes that the compounding frequency is semi-annual. Very important one. And forward rates are interest rate that span future periods. Like there is one more video that was covered yesterday. So if you want to have a look, you can just at the top, just click on I button. It will take you to that video. It will definitely help you with one of the nice numerical on spot forward rate. It's basically like, say for example, if you're standing here at t equal to 0, and here it's t equal to 2, and total the time length is t equal to 3. So what would be 1 year rate if I stand here and if I'm looking further? So this is 1 year forward that will start 2 years from now. So today we are here, a rate that will start at second year, and that rate is applicable for next 1 year. So that is 1 year forward starting from 2 year now. So 1 year forward starting. So 1 year forward rate starting 2 years from now. That's the forward rate. And the par rate is the rate you use to discount all the bond cash flows so that the price of the bond is at 100 or a par. So a discount rate that makes the bond price as 100. Basically, it is used to determine what is the rate a bond issuer should pay to its bondholder if that issuer were to issue bond today, some point after issuing bond. So that's about it. And this video will mainly focus on understanding the relationship between these three curves. So it's important that you understand mechanics of calculation little well. We will try to cover this in next slide, but still some background is needed. So this is a table that you may see in your book, and like usually you are just given the spot rates. So this is a tenor, this is a spot rate, and these are derived. Like you can derive 6 month forward par rate from these spot rates, and this is of actually it's directly not used, but yeah, to calculate par rates you need these discounting factors which are used here. So what we'll do, I'll just show you how these calculation can be done, how the entire table has been filled using this example. So deliberately these three boxes have been kept blank. I'll demonstrate this, and then we'll jump on in Excel, wherein we'll try to understand relationship between spot rate, spot curve, forward curve, and par curve. So these will derive the curve. This is tenor, these are rates. So we can have spot curve. Likewise, we can have forward and par curves, and we will just try to understand or try to establish relationship between these three curves. So let's see how do I calculate forward rate for 6 months. So if I were to calculate this forward rate, it's quite straightforward. You can just, and very important to note, the compounding is semi-annual. So you need to bear that in mind. So I'm just focusing on this forward rate. So 1 year forward, sorry, 6 months forward, that will be applicable from, I mean, that will start after 1 year from now. So that's something I'm trying to. So something that will apply between these 6 months, that is 6 months forward, starting 1 year from now. How do I calculate that? Let's see. So it's very straightforward. Like in numerator, you will have the tenor, which is in the future. So I'll do 1 upon the spot rate is 3.63% over 2 to the power 1.5. So this is your maturity, and the compounding frequency is 2. So there would be in total 3 semi-annual periods that will come till 1.5 year maturity. In denominator, you will have 1 year details, like I use this and this. Now I'll use in denominator, it would be these two. That will give me the 6 months forward rate. So in denominator, I would have 3.02% divided by 2 to the power. Over here, it's 1 year. So maturity is 1 year, 2 semi-annual compounding periods, and minus 1. This is something that will get me the forward rate, 6 months forward rate. And then we'll check how par rate can be calculated. Par rate is a bit tricky, easier one, but it's slightly lengthy in the calculation. But meanwhile, first let's calculate 3.63 divided by 2. It's 1.815%. And if I add that in 1, so it gives me this number, 1.01815 divided by, let's see how that comes to, 3.02 divided by 2 percentage plus 1. It's 1.0151 minus 1, and this would be equal to, it's like 1.0030046 minus 1. So if I subtract that, it would be equal to 0.003. So it has to be multiplied by 2 because I think it's semi-annual. So it is RF by, it will also give me a semi-annual compounding rate. So if I were to convert that annually, it has to be multiplied by 2 entire thing. So let me just write it over here. Likewise, 2 into this bracket. I think there is some issue. Let me just rub this up and recalculate, because I think we did not do the power. So power has to be done. So this is something that we have to do. It is just a bracket term. So to the power 3 and to the power 2, and this entire bracket times 2. So let's see what we end up getting. 1.01815 to the power 3. I'll store this in number 1, and 1.0151 square, store that in 2, recall 1, divide by recall 2, That's somewhere around 1.02%. Let me just 1.0242 minus 1, and that's around 2.42, and we will multiply that by 2. Let's see how much we get. It's around 4.85%. Let me just verify if that's correct. Yeah, that's correct, 4.86%. So this, if you calculate this thing, you will get 4.86%. So this is 4.86%. And if we were to calculate par rates, it's a bit tricky. So for par rates, you need the discounting factor. For maturities before, so say for example, if I were to calculate 1 year par rate, I will need all the par rates, all the discounting factors before 1 year maturity. So like for 0.5 years, we have already discounting factor. For 1 year, we will calculate discounting factor. So usually discounting factor is denoted by 1. And how do you calculate discounting factor? It's 1 upon 1 plus, so your whatever your spot rate, like how we did over here. So 3.02% divide by 2 to the power 2. So I think we will have this number in our slot memory. So I'll just recall that and do the reciprocal. So I'll just recall 2 and I'll do 1 by x of that. So I'm getting around 0.97. That's a very easy way. You can just try for all the rates that you see over here. So it's around 0.97040705. So that's the discounting factor. Now to calculate par rate, what you need to do is, there is a formula in your book for par rate. There is a derivation for that as well. If you're interested, you can just request in the group. But yeah, for exam perspective, you can just remember this formula. If you were to derive 1 year par rate, it's twice of 1 minus 1 year par rate. So whatever is the, say for example, if you were to derive 3 year par rate, so it would be 1 minus D3. And in denominator, you will have all the some of all the discounting factors before that maturity. So for this one, we just have this 0.99 plus 0.97. If this would have been 3 year, all these discounting factors would have been added. I'll show you that in Excel. In Excel, I have derived this very easily. So, but over here, it's just one discounting factor before 1 year maturity. So 0.99 plus 0.97. So we'll calculate this and we'll see what we get. So 0.99 plus 0.97. Reciprocal of this, I'll store this in 1. And I'll do 1 minus 0.99 into 2. And I'll just multiply this with by recalling 1. So it's around just give me a moment. I think there is some mistake. Okay, I think over here it's D1. I did D 0.5. So it has to be 1 minus 0.97. So it's 0.03, twice of that, and multiplied by recalling 1. So it's around 3.06. This looks sensible to me. So par rate is 3.06%. In this way, the entire table has been filled. For your comfort, you can just try attempting something from any of the rows that you see over here. But yeah, the logic behind building entire table is this. I'll show you in Excel also. In Excel also, you can see implementing these formula in Excel is also a different, altogether different area to be explored. So this was, if you notice, this was for upward sloping. So if you notice spot curves nature, it's upward sloping. And for that, these are the respective forward and par rates. We will see the relationship in Excel for these. And now we have this a downward sloping curve, wherein we will calculate this stuff in the same way. So 6 months forward rate. So when I talk about 6 month forward rate, usually initially I get RF by 2. So let me just write, then we'll multiply it by 2. So over here, it's like 1.5 year rate is 4.35%. So 1 plus 4.35% divided by 2. Again, in the power, it would be 1.5 into 2, 1.5 being maturity, 2 being compounding frequency. And in denominator, it's 1 plus 4.65% divided by 2 into 1 year maturity, 2 compounding periods minus 1. Important to note, we will this fraction to reduce the discounting factor. So let's calculate this, how much we get. So 4.35 divided by 2 percentage plus 1. So I'm getting 1.02175 to the power 3 we had to do. Let me do power 3 and store it in 1. Likewise, what I'll do, 4.65 divided by 2 percentage plus 1. It's like 1.02325 square minus 1. Let me just do square of this and store it in 2. Now what I'll do, recall 1 divided by recall 2. I'm getting around 1.01875 minus 1. So if I subtract it from 1, and it's around 1.87%, but if I were to, so this is by RF by 2. So if I were to calculate RF, it would be into 2. It's around 3.75%. So let me just have a look if this looks correct, because I see 3.71 and 4.24. Yeah, it's correct. Maybe some, because if you notice it from 4.25, yeah, it's downward sloping, so it's fine. And for par rate, as I said, we'll calculate this discount rate first. So I'll just recall to and reciprocal. So it's 0.9550, 728, and 37. Now in the same fashion, uh, I'll not write a formula. What you can do, it's just this thing for denominator. It's just this thing that you need to do reciprocal of this. You will get this number. Now for par rate, the same formula. 2 into 1 minus uh, this thing 0.9550 whatever this number is, divided by 0.9753 minus plus 0.9550. So this is a formula 1 minus Zn upon summation of Zs. This is the formula for par rate. So let's see how much this comes to. So in denominator, I'm getting around 8.98%, but then we have to divide it by something. So recall 4 divided by recall 5. So I'm getting around 4.654. So around 4.654%. So in this way, you can again try uh, any random row and try to fill. It will definitely help you building concept or building the calculation. So it will help you not mistaken, because usually when it's divided by compounding frequencies, not annual, there is a lot of chance that you may end up missing something. So it's very important that you perform some at least one row of the calculation. So let's see how the relationship between these look like. So this is what you see. I mean, the remaining part has been calculated in Excel. Same Excel was imported in your PowerPoint. So if you look at the curves, so spot curve is increasing with increasing tenor. That's why we say it is upward sloping. But if you try to plot these spot rates and the forward and par rates that we calculated in this plot, you will notice that the spot curve is always in the middle, but because it is upward sloping, the forward rate is quite higher. So this orange line is forward rate curve, 6 months forward rate curve. So if you notice, it is highest and the par rate is lowest. So for upward sloping, when future expectations are high, forward rates would be highest and the par rate is lower. Okay, so that's what this point is saying. A spot is in the middle, forward rates are highest because your curve is upward sloping. Likewise, if you look at the downward sloping curve, spot rate would be in middle only, but the par rate curve and forward rate curve will flip their positions. So if your curve is downward sloping, that means future expectations are lower. So forward rate curve will come down. So what in upward sloping, this orange line was highest, now it's lowest, and par rate has gone above. So if you look at par rate, it is most of the time it is higher than the spot curve. So par rate is highest and forward rate is lowest when you have got a downward sloping curve. Hope you are in a position to establish the relationship between these three curves, and you found video to be useful. If you agree, please do acknowledge us on the in the comment box of the channel, and please do share with your level 2 people also. They also might not have ever thought about establishing this relationship between these three curves and understanding in detail. Stay connected. Thank you for staying till the end of the video. Thank you.